How investors can qualify for short-term rental financing even without W-2 income. The short-term rental market has created a new kind of real estate investor, one who doesn't fit neatly into traditional lending boxes. These are the Airbnb and VRBO operators with strong booking histories, solid cash flow, and proven systems, but little to no W-2 income or conventional tax documentation to show for it. For many lenders, that's where the conversation ends. For us, that's where it begins. But we approach it differently, qualifying based on property performance instead of focusing on personal income. We evaluate the property as an income-producing asset. Here's how.
Projected short-term rental income. We analyze expected rental revenue based on market data, historical performance of similar properties, seasonality, and occupancy trends. If the projected income supports the mortgage payment and expenses, the deal has a strong foundation. Cash flow is king. At the end of the day, we ask one key question. Does the property pay for itself, and then some? If the answer is yes, that opens the door to financing options that don't rely on traditional income documentation. When projections need support, 1007 and 1025 reports, if the initial projections aren't quite enough, we don't stop there. We can pivot to market rent surveys, 1007, or small residential income property reports, 1025. These reports provide third-party validation of rental income potential. They help bridge the gap when projections alone don't meet underwriting requirements. No personal income documentation required. In many cases, we can move forward without tax returns, W-2s, pay stubs. As long as the property's income supports the loan, the borrower's personal income becomes far less relevant. Here's a real-world example. An investor comes in with one successful short-term rental and wants to purchase a second property in a popular vacation destination. The first property shows strong booking history. The new property is in an even better location. Comps indicate high nightly rates and occupancy. However, their tax returns show minimal income due to write-offs. Instead of declining the deal, we analyze projected rental income for the new property, compare it against market data and similar listings. We confirm that the expected revenue covers the mortgage. When the numbers support the deal, we move forward. Note with no income docs required. That's how investors scale. From one property to a portfolio. This approach is essentially powerful for investors looking to grow. We frequently help clients transition from long-term rentals to short-term strategies, acquire multiple properties over time, build scalable income-producing portfolios. Each deal builds on the last, using property performance, not personal income, as the foundation. The key mindset is there's always another path. If you do not qualify one way, we don't stop easily. We help you adjust your strategy. That might mean reworking income calculations, using alternative valuation methods, structuring the loan differently, leveraging the property's cash flow instead of personal income. The goal is simple. We find a way to make the deal work responsibly and sustainably. Here's the modern investor profile. Today's real estate investors are evolving. We regularly work with short-term rental operators with multiple active listings, investors scaling from one property to a full portfolio, buyers targeting high-demand vacation markets, long-term landlords converting properties into short-term rentals for higher yield. These borrowers often have strong revenue, but their income doesn't show up in traditional ways. Maybe you reinvest heavily, write expenses, or operate through LLCs. On paper, you may look underqualified. In reality, you're running a profitable businesses. When the deal looks perfect, except for the income, let's paint a common scenario. A borrower identifies a property in a high-demand vacation market. The location is strong. Comparable properties comps support the value. Occupancy rates in the area are high, and nearby short-term rentals are performing well. Everything about the deal makes sense, except the borrower can't provide W-2s or tax returns that reflect enough income to qualify. Traditional underwriting would likely decline this file.
The short-term rental space is full of opportunity, but it requires a different approach to financing. When the property makes sense, the market is strong, and the numbers work, there are solutions. Please support our channel by sharing to your social media feed. Give us a thumbs up and your most valuable feedback in the comments below. See you in our next video.